Absolutely.
When we talk about tentative signs of recovery, we're looking at a very distressed market perhaps a year ago. Are we looking at a stable market right now, and are we over the worst?
I think by and large we are. I think the fundamentals of the industry are relatively sound. If you look at some of the economic indicators, GDP growth is on a slight, albeit gradual upward trajectory. The inflation band, although we're outside of it currently, indications are that we'll be back within the inflation targeting band during the course of next year. Interest rates sort of are fairly flat, albeit that we see a gradual increase towards the end of next year. So nothing of particular concern there, and I think relatively stable. Yeah. So allied to that is the fact that I think when we entered the downturn 3 or 4 years ago, we entered it in a situation where we were in a significantly healthier position than perhaps some of our Western counterparts. There was supply had not exceeded demand. Activity took place in response to demand. I think there was a significant slowdown. We've seen that in the building statistics that have come through. Year-on-year building completion in the year to July 2011 was about 44% down on the preceding period. So it suggested that the market had slowed down. So from that point of view, I think we're relatively well positioned. I think that the key unknown for us is the global economy, and in terms of what impact that will have on the local market, because clearly we are going to be significantly impacted.
Absolutely, it's also a sentiment game here. But within the commercial property space, we're looking at retail, office and industrial property. Let's touch on office, because we saw office vacancies still sitting at 10%, the vacancy rate in the first quarter of this year. What kind of numbers can we expect now? Have we moved away from that double-digit vacancy number?
Not yet. I think it's sort of stagnant around the 10% mark, so we still have some challenges there. It again is very node and geographic specific. So that doesn't suggest that there are not opportunities within certain nodes, but the market generally still has some oversupply to take up. But I think it's a reasonable number. I don't think it's a number to cause unnecessary concern. And again, if you go back to the buildings completed, it suggests that there hasn't been significant new stock, and that's what we've seen in terms of our activity over the last year to 18 months. We haven't seen significant new activity coming to market, which is a healthy and I think responsible approach to where the market
historically, what is a healthy vacancy rate within the office space? And let's take us back to the 2004 to 2006 period, where we actually saw a very robust office space environment.
Yeah, I would say, look, anything above sort of 12 to 15% would be cause for concern. So at the moment at 10%, we'd like to see it coming down, and indications were that it was coming off. It seems to stabilize at the 10% mark, but I think what we are seeing is we're seeing pressure on rentals, and I think that's sort of reflective of the fact that there is still some take-up to occur. We are not seeing rental increases. We're seeing them inflation-related, but the challenge is the utility costs that are coming through, which are increasing at a significantly higher rate than inflation.
Absolutely. When you look at the estimated rental values that we've seen across the board, it seems that the negotiations are becoming slightly tougher and more aggressive. And as you alluded to, the utility costs, escomm, tariff increases been, of course, a very big unknown within the industry. How's that been taken, and are you finding that people are starting to cope with the rental environment far better? I
think they are. I think projections just have to be a lot more reasonable in terms of cash flow projections and cash flow sustainability. And certainly when we are looking at new lending opportunities, we are having to factor that in because of the unknown. So you are seeing a compression. I think what we're going to start seeing is the level of negotiation between landlord and tenant taking on a different dynamic, because historically, of course, tenants would be responsible for the full electricity cost. With that increasing exponentially, it is putting pressure on their ability to meet escalating rentals.
How has it been taken up within the retail space? And also fascinating to note when you look at shopping centres and the increase of the retail space in the country, year on year, in the first quarter of this year, we saw a 20% increase. Is there that much demand out there?
Well, yes and no. I think we've got to look at that again in the context of what preceded it. There was very little activity, so the 20% increase was off a fairly low base, being the 2 years preceding that. So we have seen largely the retail sector holding up pretty well. Certainly the regionals and super regionals have performed exceedingly well through this downturn. The area that has seen challenges is those areas where centres have not had dominance in a particular area and been competing amongst themselves, because the footfall has reduced in a lot of those centres. Some areas, for example, some of the coastal towns where it's very much a leisure market, and we've seen the fall off in the second home market, are seeing perhaps a greater level of stress than the more, the areas, the suburban or urbanised areas.
Michael, can we anticipate a closure of some shopping centres down the line if we do see more actions coming through from the global economies?
I think it is a reasonable possibility, but I think those are the centres where fundamentally there were challenges at the outset, and as I say, I refer to those areas perhaps where they've seen the residential market around it taking pressure, and particularly, therefore, as I say, in the second home market and the leisure market. Centres that are servicing that market are naturally going to feel a greater degree of stress than centres in more established
What did
urban
put,
areas.
of course, the brakes on property developers in 2008 was the escomm crisis.
Absolutely.
Because we weren't really sure if we would have enough electricity supply to cater for all the new developing that was going to happen within the construction space. This actually worked out to our benefit because we're not sitting in a scenario where we're seeing oversupply. Is that the correct
Absolutely
assumption?
right. Look, and with the benefit of hindsight, it's a wonderful learning to have had. But there certainly was, I think, if ever there was a risk or a time when the market ran the risk of overheating, it was exactly then. So I think the fact that a lot of developments simply couldn't come to fruition, which otherwise would have, in retrospect, was a blessing in disguise. And I think the brakes that were put on then was really, I wouldn't say the market was at a crossroads, but that was a point where we ran a realistic risk in certain sectors and certain areas of an oversupply, which, as I say, as a result of that and other factors, didn't come to pass.
Let's touch on the industrial property space now. We saw the manufacturing number for August coming through at way above expectations, setting 5.2% year on year from contracting 6.5% year on year the month before. But again, the manufacturing space, a very sensitive area, and of course it is going to impact the industrial property space. Are we seeing a strong recovery there, or do you find that landlords are being relatively cautious on expanding their businesses?
I think they are, as naturally the global environment again that we find ourselves in, we've seen, I think, a degree of weakening in the rand, which typically would benefit the export market, but the fact that there's this degree of uncertainty in terms of the global economy prevents a more aggressive approach being taken to industrial expansion. Having said that, the industrial market has held up relatively well through the downturn, and I think is probably best position of all the sectors to sort of face what 2012 brings, because of a lack of quality available land and serviced land in that sector. So there's limited opportunity, and as a result, it's held up pretty well, and we expect it to going forward.
Okay, Michael, so give us exactly what you expect for 2012. Are we expecting a better growth environment? Does it really depend on, as you alluded to, the global scenario that is playing out? Because here in South Africa, we're expecting around 3% growth for this year. We might just get another rate cut, and that could all be beneficial to the property market.
All things told, I would say yes. We're certainly in a better position now than we were a year ago, and I would say this time next year we'll be in a healthier position. So all in all, slow but sustainable recovery.